Good morning, everyone. It is Sunday, June 7th, 2026. I just want to showcase a couple items I recently posted on X about regarding leverage exchange traded products. The first is absolutely free on the homepage of FRAWD Research. So this is a clock here that will calculate the gains or losses to investors from 49 of the largest leverage exchange traded products. That list is expandable here. What it's doing is basically summing what the products were sold to investors at versus what they're at now. So if they were sold for 100 and are now worth 150, investors made 50. If they were sold for 100 and they're now worth 70, investors lost 30. So this is looking at a custom time period of the last 30 days. Just going to look here to year to date. Actually going to change this this date here to June 1st. I'm going to hit the refresh button. This will tell us how much investors made over that time period. So from the beginning of the year through the beginning of the month, the first 5 months, investors collectively made 27 billion. Whoop, just updated, did a little calculation, $42 billion in gains. To give some context, if you look at throughout the history of these 49 products collectively since inception of the products, and some of them range back towards 18, 19 years now, there's been about $200 billion of cumulative investor losses. For those that know me, know that my claim as a whistleblower is that those losses are engineered losses, and that the products are being funneled through fiduciary intermediaries for end exposure in products like CITs, collective investment trusts, PIVs, private investment vehicles, stuffed into other ETFs, and essentially make it into your 401k plan, your pension plan, other investment products where you have exposure, but you don't know you have exposure. You're not choosing to invest in LATF. Someone else is choosing to do that for you at your detriment. So I made a post saying, hey, there's $42 billion of net gains. This would be extremely rare to be long-lived. Essentially, that's a $42 billion paper loss for Wall Street. Why I say it's a loss for Wall Street is these products are, the performance mechanism is either notes or swaps. They're essentially IOUs, they're legal contracts. So theoretically and operationally, if you can write offsetting notes or offsetting swaps and they both decay in value or they decay in value on net, you can make money. No different than how a casino operates. Game is put up where the probability, the long-term probabilities, the long-term profitability is known, assuming no one cheats, and you essentially create a casino. I say that casino can be gamed, that you can essentially count cards. If you're interested in that, you can look at the rest of my work. So $42 billion of loss, I basically said, hey, this is going to revert hard and quickly. And we'll just go from 6/2 to today. We'll check and see what happened. It's crunching a lot of data, so it takes a moment. The date didn't, sorry, custom, change the date, 06/02/26. I did a follow-up post that said, just in the past 2 days, roughly 20 billion of that 42 billion was made back by Wall Street. I also made a prediction that it would be very rare on a yearly basis that investors did not lose money in these products. And I said for the remaining 7 months, I would look for an additional 27+ billion dollars to be extracted from investors from these products. So you can check this every day. It's absolutely free. Now want to showcase, for those who have subscribed to FRAWD Research, I list a portfolio of essentially the same model I provided to the SEC and traded for 2 years, which resulted in 886 trades and a profitability of the first year of a 30% return. These are gross returns, while the market went down 15%, so 45% outperformance. For the full 24-month period, 53% return in gross versus the S&P's 15% return. So drastic outperformance, and with that many trades, for all of you who have traded multiple times, you know the impossibility of making that many trades and beating the market from by that amount. The gross return was 41%, so about 6% per year in borrow fees and in slippage and in paying the dividends, all cash events. That was provided to the SEC through my attorney. So what I'm saying here is factual. Happy to share the information publicly of all those trades. So just going to look at two quick portfolios. Since September 4th, I have listed trades daily. What my execution price, once again, this can be audited or validated, or as I'm going to recommend in a moment, followed going forward. Paper trade, see how it performs. No need to risk your money. You're not paying me to manage your money. I am educating and blowing the whistle on these products. My view is that over a long enough time period, my work will be irrefutable. I believe it's irrefutable already. I've published so much of it, but questions will start being asked. Why is this so predictable? If someone can count cards and be so profitable, two things. Why can't I? So eventually everyone will follow what I'm doing. The products will collapse. And then the question of investor harm, litigators will come in and do their job. My goal is to make it a little bit easier for them. So we'll see. So the fraud portfolio, we'll check that out real quick. This is looking, as I mentioned, from September 4th through the present when this dashboard went live. We'll let that refresh here. Okay. So over the past, 8 months, 8 months and change, the fraud portfolio has made 22.09% return. This is after all cash events. It's had a beta of 0.5. The alpha is 24%. The max drawdown has been 7.96% over that time period. The current borrow rate for the portfolio is 9.99%. That's due mostly to the position in SMST, which is over 107% borrow at this point in time. I've made it easy so you can change based on your portfolio, your hypothetical portfolio of $5,000 for those that are learning, to $10,000, $100,000, or $1 million. Just for fun, we'll just update this to $1 million. As I said, right now it's showing the allocation based on $5,000. I'm short all of these products. My point is generally that if Wall Street is selling something, they know, like a casino knows, the probability. So if they're selling something, they have liability on the other end. That means that these shares have to be redeemed at some future time. It's no different than a debt. You have a claim on something and they owe you the performance. If the performance is positive, they lose money. If the performance is negative, they make money. My statement is very simply, Wall Street doesn't create products they lose money on under any scenario. And if they are giving you a piece of a contract that says they owe you 3 times the performance of something over time, they have a lot of liability, which means that the math and the expected value of their returns have to be greatly in their favor. So here are all the current lots. Here's the current portfolio. The open lots are here. If you're interested, closed lots of everything here. The cash events, I've aggregated those on a monthly basis when they get charged to my account. So this is a little bit not an ideal view, and it's very hard to look at the daily trades. So at the request of users, I made a different view. Same information, a little bit different. So FRAWD trades today and the performance. As this pulls up, I'll just make it the $1 million portfolio as well. Okay, this is the $1 million portfolio. The return for the FRAWD portfolio over the past 8 months and change is 25.8%. So far, there've been 3.71% of fees to the account. The net return, so this is after all fees, slippage, interest, expenses, dividends that are paid out, because when you're short, you owe the dividend. It's 22.9% versus the S&P's return of 13.62%. So 850-ish basis points of outperformance. Extrapolate that over 15 years and you're crushing the market. So here were the trades I placed on Friday and their execution price. So once again, you can change this according to your portfolio. It scales up or scales down because we're trading shares. So it scales really nicely. Here are my opening trades. Sold short BITU, LABD, MSTX, SOXL twice throughout the day as it was tanking. TQQQ twice as it was tanking throughout the day, TSLR. So, and my beta covers were GGLL, NVD, SOXS, UVXY. Chart for the performance from September 4th through present. You can see the outperformance check on a day-by-day basis. Here's the current portfolio and the current market value. This is based off if you're allocating $1 million and want to stay in proportion with my portfolio, that's it. Here's the opening transactions. So here are the opening transactions every single day and the execution price. And we'll keep scrolling down here. There's over 300 trades in that time period. Once again, I'm proving multiple points here. I'm proving not only am I right, but that it's also not luck. I'm only shorting in this portfolio. And the closing transactions are here. Okay. So here are the past trades for the past 5 days. This is very important. So all the sell shorts, all the buy to covers. Remember, this portfolio is active. It's based on a model. The model on my side is static. I have released the models that are using, this is a blend, in my book, Structured Fraud, on Amazon. This is provided to the SEC. It's what I provided to the SEC before I traded for the 2 years. So you've heard me talk about the Handsome Rob model, the double down, even money, and man in the mirror, as well as day late dollar richer, which is just following the flows in and out of these products. This is an optimized version of that, which stays with my IP, but the models are out there. Mix and match as you wish if you'd like. So how do you know I'm not full of shit? Well, here's my recommendation on what I would do if somebody made these claims and I wanted to test and prove them. First, I would never use my own money. I would paper trade. So my trades are listed. I try to trade and very rarely trade within the last hour of closing, but I do trade throughout the day if the model dictates. And when I wake up in the morning, I'll look at what the model projected overnight, and I will make trades accordingly. So you will never get the same execution price as me because I'm not listing the trades before I make them. But as soon as I make them, they will show up on this dashboard. So sometimes at the end of the day, if I wanted to test this, I would simply look at what trades were made, and I would use the closing price just as an assumption, just to test on how these do. So if you're testing today and wanted to see how this would perform in the future, I would paper trade all of these products you're short, the number of shares, and this is the closing price from Friday. I would do that every single day until I felt comfortable one way or the other before making or allocating any money. Once again, my point is I'm a whistleblower, I'm an educator, I'm an investor advocate. I'm saying I found fraud and I can count cards. It's up to you to validate. No one's going to validate that for you. But I'm providing you the means, mode, and methodology to do that on your own. Awesome. I will probably showcase this going forward periodically. The subscribers to FRAWD Research obviously have this on a daily basis, and many of them are kind enough to be validating this on a paper trade basis on their own. It's, in my opinion, all frauds collapse over time, and I want to push this one along. I only make money, or any substantial money, through a whistleblower award and protecting investors. It's been my goal from day one. I've been very open about that. I've been very open about my claims and my evidence for the past publicly in some form or another since 2021, and been a whistleblower since 2019 on these products. At some point, they will be systemic. At some point, they will collapse. I'll tell you the mechanism right now on how that's going to happen. Because these products are based off of IOUs and have counterparty risk, meaning that the issuers are purchasing total return swaps with Wall Street firms such as Goldman Sachs, such as Nomura, such as JP Morgan, such as Citi. The second one of those has an issue and they cannot make their claim, meaning they are not going to make their obligation to swap. You have swap risk or counterparty risk, which is disclosed in the prospectus. When one of these firms goes out of business or has financial trouble, think 2008, it will create a cascading effect because it will already be in a stressful time, as you can imagine, financially. From a financial perspective, so if Nomura doesn't make swap payments on their, let's call it net $25 billion of exposure, that means that product is going to collapse. And the cascading effects will go from there. I've put this in my first whistleblower complaint to the SEC. It's one they asked me about on my phone conversation, and one I believe they're choosing to ignore. So it's out there in the open. We'll see what happens. Once again, regardless of your portfolio size, I'm basically saying, allow me to paper trade your portfolio, and let's see if I can not only outperform you, outperform the best asset manager you've ever saw, on a basis. One last thing I want to say is I've only released publicly the bottom quartile of my work, which means my other models, which are based on different criteria or a more optimal mix, or by using leverage, such as options, can meaningfully increase the returns I am showing to the world, with at most times even lower risk. So there's the information. Have a great Sunday. We'll see you later.